Good day, grade 12s. Welcome to Exam Prep International Trade. My name is Carden Madzokere. I'm the author of the Distinction Bound Student Textbooks. And as usual, we're going to go through some past papers. And in this particular lesson, we are focusing on international trade. So let's have a look and see what has been coming over the years and how it could help you to pass your matric. Right, let's see. The first one here will be study the graph below and answer the questions that follow. So let's see what's going on. Initially, we have demand and supply there, and this is our point of equilibrium. And then we see a shift of the demand curve to the right. And this is demand and supply of foreign exchange or foreign currency. Okay, we have 100 units, 130. There's an increase in demand. And then we see this movement here from 10 to 12. So this is the rand against the dollar. So what has gone, the demand for foreign currency has increased, and this is the supply of foreign currency in this case stayed the same. So what has happened here is the dollar has appreciated and the rand has depreciated due to an increase in demand for foreign currency. And this could be as a result of so many things, but one of them could be that we are importing more than we're exporting. Right, identify the original equilibrium point. That will be point E. I've said it already. What happens to the value of the rand when the demand curve shifts from DD to D1? The rand will depreciate, the rand will decline, or the value of the rand will decrease. And some of you would find it confusing, like, why do we say the rand is depreciating if it goes from 10 to 12? It's depreciating because you need more rands to buy the same dollar. You see, you used okay, fine. Look, let's say this happened from throughout the day. Okay, that will be a big drop. It's normally abnormal to do this. And if it does, wow, we can say that the rand is so unstable. This could take time to happen. But anyway, let's say it changes from 1 to 10. Let's say, okay, fine. Let me try to create a scenario here. Your salary is 10,000 rands. So in other words, if it's 1:10, it means that your salary in US dollars, okay, will be, dollars, will be $1,000. Now, if your salary remains the same and the exchange rate changes from 1:12, you'll see what's going to happen there is that you're still earning 10,000, but now the exchange rate has changed. So now it will be more like your salary is 833 rands, $33. So if your salary drops from, but look, your salary is still the same, 10,000. So in January, you earn 10,000. That is equivalent to $1,000. In February, the exchange rate changes to 12. That means your salary is now $833. So why has it gone down? Because the value of the rand has decreased. All right, I think you understand now. Briefly explain the floating exchange rate system. Okay, this one here is a floating exchange rate system because it uses forces of demand and supply. Because if it's not a floating exchange rate system, it's a managed exchange rate system where the central bank is, or if it's not managed, it's fixed. Maybe it's fixed to a certain commodity, usually to gold, or it's fixed to another currency. Okay, so this one here is a floating exchange rate system, and that is what South Africa is using or claims to be using. What effect does globalization have on international trade? Okay, this globalization is when countries are trading So it will stimulate international trade. Countries will trade with one another due to globalization. And that is what we're doing currently. It allows a greater variety of goods and services between countries, because you will have the luxury to buy what you like or what you can afford. So it is possible with globalization. How will demand influence foreign exchange? The demand will influence the foreign exchange by importing goods, payment for services from foreign countries, tourists spending money overseas, buying shares in other countries, and many more things that you can think of. If it's not shares, it could be property, anything, just when money is going outside the country. Another one here, same scenario. We see a depreciation of the rand. There's a very common thing, and a shift of the demand curve. We have an increase in quantity demanded and supplied, like that. Let's see. Identify the exchange rate system. This one is a free floating, just like we had before. So it's just a change of questions. So just be familiar. What was the original rand dollar exchange rate? That was 13, 1:13. Briefly describe, you see there. Briefly describe the term exchange rate. Exchange rate is the rate at which one currency can be exchanged for another. As simple as that. For example, rands to dollars, pounds to euro. How has the increased demand for US dollars affected the value of the rand? The rand has depreciated, like we said before. It has depreciated from 1:13 to 1:14. What could the South African Reserve Bank do to strengthen the value of the currency? And if the Reserve Bank does something, it sort of, contradicts with the free floating idea, because now there's a bit of intervention happening there. Right, the Reserve Bank, a couple of things that they can do. Number one, they can sell US dollars in reserve in the foreign exchange market to create an oversupply. So if they sell USD, it will be something like this. Now, look, the rand will appreciate to maybe 10. You see, if supply was to shift to S1, we have a new equilibrium, which is not this one, but this one here. Right, selling gold reserves on the international market to create an oversupply. So the rand will appreciate against gold. Obtaining assistance from the International Monetary Fund to increase the inflow of foreign exchange. The next one, increasing the repo rate to stimulate investment by foreigners in the South African economy. Another one that I don't see here could be that, but it's more or less the same as this. The South, when the government is selling the dollars, they oversupplying the dollar. But one of the things they can do is to buy their own currency. So they can use the dollars they have in reserve to buy the rand. And instead of us talking about oversupply of the dollar, it could be an increase in demand for the rand. So if we sell dollars we have in reserve and use we're selling them or we're exchanging on the open market, we're buying the South African rand. By so doing, we are creating demand for the rand, and you know what will happen? The rand will appreciate thereafter. The next one is study the table below and answer the questions that follow. This one here is a balance of payment, and that's a systematic record of a country's transactions with the rest of the world. As you can see here, they made life easy for you. They put this less, which will make it very easy. So normally we'll take merchandise exports, we add, net gold export, add, service receipts, add, income receipts, add, merchandise imports, subtract, payment for service, subtract, income payments, subtract, and then current transfer. This one is mostly a net figure, so we do what it says. In this case, it's a negative, so we'll just subtract. All right, so this is how we'll get to this figure here. But why do we add merchandise exports? Because if we export, these are all the goods that we export. If we export, money comes in. So we're talking about the flow of money here. Money comes in, so we add. And sorry, I pressed that by mistake. Which institution provides the statistics above? That's South African Reserve Bank. You look here. But let me finish what I was saying here. Net gold exports, goods are going out, so gold is going out, so we add, money is coming in. Service receipts, we render service to foreigners and they pay, so we get the money. Income receipts, it's payment coming to South Africa for anything, let's say labor. Merchandise imports, we're buying things from other countries, so we subtract. Payment for service, they render service to us, so we pay for it. Income payments, yes, we're paying for labor to foreign internationals, so we subtract. Then current transfers, this mostly is like, let's say donations and gifts. So it depends on who, sent what more. If I have a brother in Australia and I send him money goes to Australia. But do you see that that money is not going to Australia so that something comes into South Africa? It's a gift, it's gone, and nothing is coming back the opposite direction. So this one that will be different from merchandise imports, because I'm not importing something, I'm not buying anything, I'm giving my brother a gift. Right, I think you have an idea. Which item records transactions relating? Oh my goodness, I just finished talking about it. That will be current transfers. Briefly describe the capital transfer account of the, okay, it's not here, but also it's a net figure, always, right? It is a net amount that includes transactions and grants relating to ownership of fixed assets, debt forgiveness, and the value of households and personal effects, and financial claims and liabilities of migrants. So it's a net figure. So in terms of calculating, it's something you don't really need to worry about, because you never be asked to balance it. But you can be asked to balance this particular account, which is called the current account. Right, give one reason for the decline in gold exports. Less reliance. Okay, this one will be, just trying to figure out what could be the reason. Less reliance on gold as a value stabilizing commodity, could be. Worldwide recession led to low demand for gold. Closing down of gold shafts led to downscaling of gold production. So anything that makes sense. Calculate the trade balance. Okay, trade balance, we only talk about items like, okay, this, and this, only these three. So we add these two, we subtract that. Simple. So trade balance will be merchandise exports plus net gold exports minus merchandise imports. You see? So like I say, these three are the only ones. So you take, and then you have to watch out for the year. If you are not careful, you're doing the right thing in terms of, you know which ones to add and which ones to subtract, but you are not using the correct year. So be very careful. Always check which year are they asking. It's 2015, so you use 9, 67 and 1 million. Okay, and also remember this is in million rands, so at the end of every figure there you put M. So this is actually million, billion, trillion. This is 1 trillion rands. This is 67 billion. Yes, this will be 900 billion, almost a trillion, right? Okay, so in front of everything here put an M. Right, let's go to the next one. You see when it comes to this topic, section B, please take note. You should understand the graphs. You see the same graph is coming over and over, but for the first time we're seeing a shift of the supply curve. Before we were seeing a shift of the demand curve, right? Oh, but let's see. Yeah, shifting to the left, shifting to the right means increase in supply, decrease in supply. And you see what increase in supply does, it makes a currency appreciate. And in a decrease in supply, it makes the rand what? Here it appreciates, here it depreciates. Right, which supply curve indicates a decrease in supply? Okay, that will be S2. What type of exchange rate system? This is a free floating used in South Africa. I mentioned it before. Explain the term exchange rate, the rate at which one currency is trading for another. State one factor that could have led to an increase in supply of dollars. Okay, so why are dollars being oversupplied? An increase in supply of dollars. That means they are supplying the dollars, and what are they demanding? The rand. So it could be that they want to come to South Africa. Yes, it could be because of, depends on when it was. If it said here 2010, the answer would be the World Cup. They were coming for the World Cup. Yes. Right, use the above graph to explain the effect of the increase in the supply of US dollar. Okay, so increase in supply of US dollar, the effect will be that the US dollar will depreciate. Just like I said here, if supply increases, the rand, if you remember, I said the rand will appreciate. And if the rand is appreciating, it means the USD is depreciating. So the supply of dollars increase SS to S1, and the equilibrium point will be E1. And so look, if it changes from 1:11 to 1:10, it means that now you need less rands to buy the same dollar. So the rand is stronger and the dollar is weaker. Okay. And then let me see, use the graph to explain the effect of the increase in the supply of USD. Oh, so if you don't explain this way, you could explain it the other way, but you are saying the same thing, because if the dollar appreciates, the rand is depreciating, and if the rand depreciates, the dollar is appreciating. So it's always the opposite. The same one, but now again it's a shift of the demand curve. So it represents the appreciation of the dollar and the depreciation of the rand. What market is depicted? That is the foreign exchange market. What effect does the shift? Oh, sorry. If you, okay, it's fine if you say foreign exchange, but the word foreign exchange on its own is different from foreign exchange market, because foreign exchange is the act of exchanging one currency for another, and foreign exchange market is a place where one currency is traded for another. So foreign exchange is like a noun, and foreign exchange is like a verb, and foreign exchange market is a noun. So this one is a place, and the other one is something you can act upon. Right, what effect does the shift of the demand curve have on the price of the dollar? Take note, they're asking the dollar, so the dollar will appreciate. The price of the dollar will increase or appreciate. So take note what is being asked. If the question changes to rand, then the answer here, you must say decrease. Briefly describe the term exchange rate. How many times? I think this is the fourth. So make sure you don't go to the exam room without knowing how to define this term. And also, one other common thing we saw was the system, the free floating exchange rate system. You saw it's very, very common. Right, so there is the definition. What will the effect of the new price of dollar be on export trade between South Africa and the US dollar? This would mean that American goods will be expensive. So exports from South Africa will increase. Why? because Americans would find our goods cheaper. So they can get the rand at a cheaper price, meaning they can also buy more in South Africa. So that will be a good thing. It will create oversupply of the dollar, and that will cause the rand to appreciate again. And so that is why, this market is very volatile, because the minute the rand is cheap, they start buying our goods. And when they're buying our goods, they're oversupplying their currency. They're demanding the rand each time. And that will cause the rand to appreciate. So, it will always be up and down. Explain how an increase in the number of US tourists to South Africa will influence the value of the rand. It will appreciate. As simple as that. More US tourists in South Africa mean a higher demand for ZAR. The supply of dollar will increase, and that means eventually the rand will appreciate. That will result in an increase in the value of the rand. That's what I've been saying. Right, then here, study the table below and answer the questions that follow. South Africa, terms of trade. Okay, we have years 2010 to 13, index of import prices, index of export prices, and then the terms of trade. Okay, so we see that ratio there, the ratio of import prices to export prices. All right, identify the institution responsible. So you always have to look at the source down here. It says South African Reserve Bank, so that will be it. What is the trend? Take note, trend. Whenever you see that, it's either or. You see, so try to see what is the trend of import prices. So you look for import prices, then you see 141, 53, 60. It is increasing. You can see that. Right, so the index of import prices is increasing. Explain the terms of trade. Is the ratio of import prices to export prices. As simple as that. Briefly explain why an increase in the terms of trade will have a positive effect on the welfare of the country. It will mean that there will be an increase in economic welfare because more revenue is earned with the same expenditure, because we are still when terms of trade improve, it means it's cheaper for us to import. And so for the same expenditure, we get more money. Right. Calculate the terms of trade for 2011. Show all calculations. All right. If you check there, we take the 191 for that is the index of export prices. We divide by the index of import prices, then we multiply by 100, we'll get 124, and that will show an increase from 2010. So that will be an improvement in terms of trade. Right, the next one, study another balance of payment. Describe the trend. Okay, again, trend, is it going up, is it going down, is it staying the same? Or it's fluctuating. Actually, it's another possibility. Describe the trend of the balance on the current account from 2010 to 11. Okay, so we check the balance here. Negative 50, negative 60. Oh my goodness, it's the deficit is actually increasing. Increasing deficit in the balance of payment. Yeah. Describe the term trade balance. Okay, trade balance, this one here, is merchandise imports plus minus. Okay. It is the difference between goods exported and goods imported. So why do we add these two? Because we have other goods like everything else, and we have gold. So all the things we export, and then we subtract from all the things that we import, then that figure can either be positive or negative because it's a net figure. What is gold exports? Why Why is gold export listed as a separate? Okay, this used to be a very common question due to the historic importance of gold as a strategic export product of South Africa. How can the government use our currency to improve trade balance of 2012? Okay, let's look at our trade balance. Okay, this deficit here. What can government do to improve this? Okay, the government can devalue the rand. Devalue is an act by the Reserve Bank of reducing the value of its own currency to make it weaker. But now the thing is, if the rand is weaker, but what's causing it here is not floating, it's actually a deliberate act. So but the point is they want the rand to be weak. If it's weak, then people will find it cheaper to buy from South Africa. But then the downside is it will be expensive for us to import. Imports will be expensive. So if imports are expensive, then we might as well stick to buying in South Africa. So I think you see what will eventually happen. It will increase the exports actually, and decrease the imports, and so our trade balance would actually become a positive. So we won't have a deficit anymore. So this will make our goods cheaper to foreign countries, which will promote exports. As simple as that. Right, another balance of payment, and each time they're giving you less, so it becomes easy for you to do it. What has happened to the contribution of gold since 2011? So let's look at gold export 70. It's been declining. You can see that. Define the term current transfer. Okay, current transfer, we did it. Yes, we did it before. This one here. It's the one I was telling you about, donations and stuff. Right, receive money without any counter performance. That means you're probably just being given a gift, or they're donating to you, and so we donate to them, they donate to us. So that figure, they make it a net figure depending on what outweighs what. If we sent more than they gave us, so it will be a negative. If we got more, then it will be a positive. Calculate the trade balance for 2013. Come on, trade balance is always easy. Merchandise. So you notice that this one is being a common thing. Merchandise exports plus net gold exports minus merchandise imports equals to the trade balance. And again, take note. You might have the formula, but you are busy doing the wrong year. Then you'll get a wrong answer. What impact will the deficit on the current account have on the economy? It will have a negative effect. Okay, it's not really answering it. The foreign exchange reserve will be reduced to settle the international debt. Domestic prices of goods and services will increase or lead to inflation or imported inflation. It will have a negative effect on economic growth. Another BOP, and let's see here we have the financial account. Thank God, because we've been doing the capital transfer accounts the most, and they changed also the way we calculate the BOP. So you should take note of the new way. You will see in one of my lessons, you will see it. Right, which item captures a South African business that purchases property in the United States of America? That will be net direct investment, because if you look at direct investment, that will be, normally we say 10% or more. So purchasing property in the United States, that is, I think, more than 10%, because mostly the 10% is what makes us say, is it direct or it's other? Because it's not portfolio, because portfolio is done through a stock market. So it's not purchasing of shares through a stock market, so it can't be referred to as portfolio. And define the term balance of payment. Okay, it's a systematic record. I always say not a haphazard record of a country's transactions with the rest of the world. So when we buy from other countries, it's recorded. When they buy from us, it's recorded. How is it recorded? Systematically. So it's that record of our transactions with everyone else. So it has to balance, and sometimes we'll see it is in deficit. So sometimes, but what we want is a surplus on a current account, but we normally just see a deficit. What is the purpose of the item unrecorded transactions? And I think it's obvious that it's there to capture or to, deal with any errors or omissions. If the balance of on the current account was 164,548, calculate the value for change in net gold and other foreign reserves, and then you show all calculations. All right, this is how you do it. Balance on the current account, it would be 164, and then capital transfer account, there it is here. I told you this will always be there, and it's a net figure, so you do what it says. If it was negative, you would have to subtract. And then the balance on the current account, you take this figure here, which is this one you see here. Then you subtract unrecorded transactions. Remember, we talked about it already. It's there to deal with any omissions or any error or any timing differences. And then that will give us a change in net gold and other foreign reserves. All right, that is it. We have come to the end of the topic international trade, and it was not very, very long. And as usual, please subscribe to my channel, share the link, show your friends, and this could help everyone. It will help you to pass, it will help your friends to pass, and yes, let's do it. We'll get our distinctions eventually.